Good morning, traders. It is Tuesday, March the 4th. Taking a look at the charts, we have more blood on the street with stocks continuing to fall. More or less, we had that trend change last week, and more or less, we're seeing everything kind of sell off and continue to drop. A few different scenarios you can see here on the daily chart. We got another big red bar hitting some new multi-month lows on the verge of piercing this significant low back from January 13th. This is a fairly significant standout low, so I wouldn't be surprised if we see that get hit today. The market loves to make Fibonacci theory and all that, make nominal new lows, higher highs and lower lows, run those levels. So we're probably going to see this low. If you keep an eye on this low on the futures or the SPY, probably see once that trigger, that level gets pierced by 1 penny or so, we will probably see a wave of orders, of stop orders get triggered, and see the market flush out. Now, this could trigger a flush out, a sell-off, and sharp rebound in terms of it runs the stops, gets people out of the market, the longs, and then has a knee-jerk reaction bounce. That is typical type of price action. So we see it's flushed down today and then potentially have a pretty big bounce percentage-wise. It could come back up somewhere near these highs, and obviously it can continue to go lower after that. But remember, some of the strongest bounces happen in a downtrend, meaning we could see like a 3% bounce in a session or two in a downtrend. It'll be one of these type of knee-jerk reaction bounces here, where the market can just flush out the lows and then pierce and then have a big reaction high. And of course, it'll get everybody with FOMO thinking, oh, it's bottomed, time to pile in, which is a good scenario. If we take a look at the SPY, I talked about this in the afternoon update or the evening update last night. If we just zoom in here, the trend, this is the 30-minute chart of the SP 500. We went into an oversold territory. Bars were green, meaning we were in an uptrend. But if the market pulls down into oversold territory too much, and we see panic selling on our indicator, meaning people are dumping shares, plus the VIX spiking, plus the put-call ratio, all of that stuff, that is usually seen as a buying opportunity. But when there's too much, it breaks an uptrend. It breaks that cycle to the upside and starts a new down cycle, which is why we have this sell short signal. The bars went orange, saying, hey, there is a trend change at play. I got a lot of flack for this. People saying, well, it's still it's just a pullback. But the short-term trend went orange and down. You do not want to be holding it when it goes from green to orange. That usually means it's going much lower. And the real key here that I shared is understanding the FOMO indicator, which is this red indicator. Let me just get rid of this one here. When we see FOMO indicator, which is the red indicator, get up to this blue line, we tend to see the stock market put in a short-term top. So in an uptrend, we're usually looking for panic selling, which usually means we're going to see the market put in a bottom and go higher. But now that we're in a downtrend and the trend has broken, we ignore the panic selling, which we had yesterday, telling us that everybody's panicking out and that a low should be put into place, although it does bode well for a little bit of a pause or a little bounce. But what we're focusing on in a overall downtrend of the market is we want to know when there's FOMO. When everybody's piling in going, oh, this market is going to go higher. When everybody does that, that is a sign that the market is about to go lower. We saw the same yesterday on the gap. You don't see it on this 30-minute chart, but we had the same when you drop down to a 3-minute or shorter term time frame. This indicator spiked way up, and it was much higher on this over here as well, showing us that there was another bout of FOMO. Everybody piled in yesterday at the open thinking the market put in a strong bottom after Friday's squeeze up to the upside, and everybody literally got in right in this little top piece, and then the sellers stepped in and just hammered the market with multi-waves to the downside, flushing things out. So understanding these sentiment shifts, when panic selling is an opportunity and when actually FOMO, when everybody is buying hand over fist on the New York Stock Exchange, is actually a bearish sign. Again, this is all stuff that I teach in my book. If you go to my website, you can go to books in the top menu section here, scroll down, Technical Trading Mastery. I do show you exactly how to set up this 30-minute chart with overbought, oversold conditions, with panic selling indicators and FOMO indicator, so you can go ahead and duplicate this and use these short-term moves to your favor. And of course, big gaps like yesterday, it doesn't look like much on this chart, but there was a big gap up yesterday. And as we know, gaps get filled. The market also likes to gap up in a downtrend because the institutions can walk the market up and they let it drift higher. And then once everybody gets excited and there's lots of volume at the opening bell, the institutions start selling into all of those people thinking the market bottomed. They can unload their shares at a higher price, and then they keep unloading throughout the rest of the day because they're trying to get out of the market. They're trying to get out of the risk space. And that is exactly what we see time and time again. Same thing happened over here. And we talked about how this gap up, this session had a big gap up. And sellers, once it kicked in, sellers stepped in and sold back down. And typical scenario, we see this once or twice a week generally. We talk about in the morning videos. I know a lot of you trade these, and one of you crushed it last week with one of those gap trades. And you said you paid for multiple years of your subscription with that one little trade. The other thing I really kind of regret missing actually was I shared this on YouTube and with everybody earlier a couple of weeks ago when we have a huge sell-off down day. My favorite trade, and I wasn't at the computer at this point, my favorite trade is actually to go against the trend. A huge sell-off, panic selling in the market, which we saw, and then this last little squeeze into the closing bell. It doesn't look like much, but when you trade futures, it's a quick couple grand, usually anywhere from 5 to 25 minutes, the last half an hour of the day. And that setup was there, and I didn't see it till after the close, but it's the exact type of day that I like for that counter trend end of close. So the morning gap trades are awesome opportunities. They usually last an hour or two, and then the end of day during the extreme sessions are also another good trade. Anyway, all right, let's take a look at what's going on in the markets this morning. We are seeing the S&P 500 and the NASDAQ trading lower. The NASDAQ, you can see, down over 9% in the last couple of weeks to the downside. This is why you do not want to be holding something when the trend changes. It could keep going. It has already broken its January lows. Lots of volume. Not a good sign for the overall market. If we take a look at the bond market, long-term treasury bonds, they continue to push higher and hold up. They are starting to act as a defensive play and starting to move up, which is a great sign. I cannot wait till bonds become an opportunity for us to take advantage of. But they are still long-term in a downtrend, but starting to put in a major bottom, and they're starting to go sideways long enough here that the downward bias is now kind of flat, and now we're just kind of waiting for the overall momentum to shift from more or less, it's gone from a stage 4 decline. Now I believe it's in a stage 1. And of course, we want to wait till it's in a stage 2 into a new uptrend. This sideways motion is a great way to waste a lot of time, a lot of random trades. It's not as accurate. So once it starts to give us that upward bias, then we'll be excited for that trade. If we take a look at the VIX, up 7% again this morning. It was up yesterday as well. Again, VIX is spiking. There is a lot of fear in this market, and that is going to potentially cause quite a washout this morning. As I just mentioned, I think we're going to break on the SPY, which is my favorite overall broad market stock market tool. I think we're going to pierce that January 13th low. We'll see a spike in volatility, and maybe we see a short-term low put in the market as it runs the stops, and then the market rebounds. And of course, we have panic selling on the New York Stock Exchange and the VIX, which is a short-term indicator that we should see a little bit of a pause or bounce. And when you couple that with running of the stops of a significant low on the SPY or SP 500 right here, which I think we're very close to potentially starting to break today or the next trading session, it'll be very interesting to see how that shakes out. Overall, money flowing out of the dollar today. Obviously, we got Trump and lots of tariff stuff going on. So we've got this multi-wave correction taking place with the dollar. Again, still overall in the grand scheme of things, big rally up, big flag. It's still in line with the overall size of the rally and the flag, but definitely would be nice to start to see things shake out and start to firm up a bit of a base when it comes to the dollar. When the stock market does, I think, start to collapse in a different way, in a bigger way, I think we will see the dollar firm up and start to go higher. But the tariff noise and news is definitely creating lots of volatility in this in the U.S. dollar index. Gold is shining again today. It's up 1.2%. It just has really found some traction and continuing to pop and push higher. It's coming back up to this level. Our upside target is 3,050. Again, I am neutral to bullish on it. Again, the big move was all the way up to about that 2750, 2850 area, which if we just zoom back, this was that 2800 we ended up hitting and then went into a multi-month pause. And now we're starting to run up. That next level is 3,050. But again, the big move really was from 2019 all the way into, which I need to zoom way back, where we broke into a new super cycle for gold. This chart, let me just go to the daily. And, if we take a look here, you can see we broke into this new super cycle right over here. And it's had that big move up, hit that target. And so right now we're in that blow off phase, just before I think an economic reset and collapse. Gold tends to hit its target, and now it's in this, like, everybody's chasing it. And the environment is rich for gold, meaning lots of chaos, uncertainty, which is good for gold. So again, neutral to bullish on it. It is still in an uptrend. You do not want to bet against it. I hold physical gold, and I don't really care if it's correcting back down to consolidate for one of these big pauses and kind of pullbacks, because I do believe it's going higher long term. And it's not a trade for quick money. It's a long-term investment hedge on just currency, on inflation, on having a different asset that's not locked up in a bank and in a fiat currency. What else do we have here? Natural gas had a big move up yesterday. It looks like it is up again today. If we zoom in, let me just get to this daily chart. Big move there yesterday, pushing up again today. Again, this is super volatile all over the place. We don't really trade natural gas, but I know a lot of you want me to cover it. It is definitely showing lots of volatility. It is so hard to pick what this thing is doing. It has a broadening formation. It has higher highs. It has lower lows. This thing moves and swings so fast. You got to be very, very cautious. We're looking at 30% swings back and forth. There's a 50% swing on this last move. So, I mean, I don't really get into playing with those. That is a totally different ballgame. And usually you have to trade very small positions, and then you have to do a lot of trades because it's a small portion of your account, and you got to watch them closely, and you have to have a whole bunch of small positions. It's a lot of work when you get into trading fast, shiny things like this. It lures people in because there's big returns, but overall, it's not like you're putting your whole account in. It carries a ton of random risk, much more risk than other asset classes. So I steer clear of it for that reason, because it doesn't fit my style or time commitment for the markets and volatility, obviously. Let's take a look over at silver. 0.45% up. Again, in the grand scheme of things, it is moving up a little bit this morning. Had a nice pop there yesterday, but pretty noisy. Sideways chart. Still, in the grand scheme of things, more or less trendless. Short term up. It does have a series of higher highs, higher lows. Looking like it found some support at the 50-day moving average, which is this blue line. And maybe it wants to move higher again, but gold is definitely the play, and we've talked about that for months. Just focus on gold, forget silver and miners. They will be random and more volatile and just not as accurate. And you might as well make money with an accurate trade and hit a first, second base hit, then swing hard and not make anything or take a big loss with silver or miners in this particular market environment. Let's see what else we got here. If we take a look at our long-term weekly chart of the SPY, the long-term trend, let's just zoom in here. We are still in the bullish environment. Again, after COVID, we had a bullish signal. We were in a rising tide environment for long-term investors. 2022, we were in a falling tide. You didn't want to own it. And we are still in a bullish environment moving to the upside. Now, it is correcting. This does look like, the markets could be putting in a significant top. We just have to see how this unfolds. Long-term investors can still be in. This little nominal new high, this sideways pattern actually is very, very similar to what we saw over here. And I've referenced this several times, that where we are right here, the underlying technicals of what the other 8 underlying assets that we're tracking and following are doing are very similar. These 2 times are very similar. And this poke to a nominal new high sucks a lot of people in. We saw that. And then, of course, from there, it breaks down and we go into a bearish environment, which, again, if I was to just zoom out on this and we go and we look longer term, again, this could get pretty ugly in terms of we go into a bearish environment typical bear market, down 20 or so percent. And then for some reason, we go into stage 4, which becomes that big financial reset where the market blows up 40 to 60%. And we go into something much, much bigger. So we got to be aware of that type of scenario. Last but not least, take a look at this index. This is the RSP, which is the equal weighted SP 500, the small caps and the micro caps. So this is like the majority of stocks as a whole, giving you the broad market kind of view. As you can see here, it looks pretty double topish to me. We had that poke to a nominal new high, which is what the market loves to do, is to make new all-time highs just before going into a big swan dive. We had this little bear flag forming. We're breaking down, and I think we could eventually see overall stocks as a whole break down. This here is going to be a very critical line in the sand where if we pause and then eventually break, that'll be a major stage 4 decline in wipeout in price as stocks as a whole. So where we are right now, there's potential for a 20% move to there. And I do think this whole market will have a much bigger correction. Now, this one will have a lot more volatility because it is also small caps and micro caps, which small caps and micro caps will fall 50 to like 85% during a bear market. So there is a lot of potential downside. Breaking the COVID lows, breaking these lows, the market will want to flush these significant lows. And kind of where I drew it is where something like this index could potentially go. And so obviously, if you're holding micro caps, you'll be down 85 to 95% on most of those little stocks. Small caps, not as much. Large caps, 40 to 55% probably to the downside. But that's kind of what I think is starting to unfold. And we're just kind of letting things work themselves out. And we're navigating this market on the sidelines right now, watching the market fall and just collecting daily interest and dividends here as we kind of wait for the next setup.